Listed property continues to be a top-performing asset class. Over the last 9 years, for instance, the South African Listed Property Index has averaged annual returns of 25%. The market cap of the sector has surged 15-fold in a decade. The question, of course, is whether this outperformance can continue. In studio to give us her opinion, Mariette Warner, Listed Property Fund Manager at Absa Asset Management. Welcome, Mariette.
Thank you.
Braving through Joburg traffic and the Rand. Good to have you here.
Yes, I got here eventually.
You would have missed our previous discussion on value investing. So this presumably would fall outside the category of the typical value investor. It's done so well. Can it continue to do so?
Strangely, property fundamentally is a value investment, but it has various macro drivers. It is typically what I call a bond equity hybrid. It has bond-like characteristics and equity-like characteristics. So if you look at the last 9-10 years since the beginning of 2003 with this massive performance that you have just mentioned, if you put that in perspective, you take the first 3 years, falling bond yields. You take the middle block of years, very strong earnings growth on the back of high GDP growth up to as much as 6%. And there was volatility in the bond market at that time. Then from 2009 to date, we had falling bond yields again. And this time, not because of the structural fall in interest rates and inflation in this country, but because of the global quest for yield. And the economy has weakened quite significantly since the run in the earnings. So what you've had here is a combination of structurally lower inflation equals lower bond yields, high GDP growth equals high earnings growth, plus global quest for yield. It just has been a triple effect, I suppose.
But on top of that, there have also been other structural elements in the South African economy. As I understand, it's been an underdeveloped sector, and you've had, for instance, the new listings, lots of corporate action, and more recently the corporate bond issuances from that sector.
That's right. It most certainly has matured a lot. If you consider the market cap relative to the all-share index, in 2002 it was 1% for the all-share index, it's now 3%. So on a relative basis it has tripled in size. So really what that means is that the better property assets, real estate assets in South Africa, are sitting in the listed space as opposed to life companies and retirement funds. That essentially has also driven the performance because the quality of assets is better.
Which is actually great for investors because we can actually get exposure to some of these these great, wonderful properties around the country. Mariette, I wanted to ask you about this disconnect that I seem to see with the listed property space. You've talked about how it's a hybrid with the bond market because investors look at the yield that they can get in bonds and they compare that with the yield that they can get in listed property. When I drive around Joburg and I was in Cape Town recently, there are so many offices that are missing, that are vacant at the moment. What's your feeling specifically around the office segment in the listed property space? I mean, is the economy, it seems at that level, it seems the damage to the economy can really be seen.
That is exactly what has happened. There was some overbuilding during the boom years, so we were left with a bit of a glut of space. And what we find is that it's the B-grade office market that typically takes the brunt. Because when the economy is weak, all of the rentals weaken, so the top B-grade tenants will move to A. So you get this glut of B-grade. What is key with B-grade offices is the quality of management. They all have high vacancies in those portfolios. Some are 10% and some are 20%. The difference is quality of management.
So that, I mean to interrupt, so yes. B-grade means it's how it's managed, not the quality or the location of the property.
The quality and location means B-grade. But within that same type of property, you get different management styles in terms of the people who manage those portfolios. So in order to mitigate that risk, you've got to go with the really hands-on managers. And in fact, it creates an opportunity because when a market is perceived to be weak, then the portfolios who own properties within that market are overly punished. So it's a good time to go bottom fishing if you like. And this is something that I like to do. You pick where is there a big opportunity and the market is a bit nervous. What the market wants now is certainty. And there's no certainty in when our vacancy is going to come down. It's a matter of assessing management, the quality of the buildings, what are they doing to mitigate the weakness in the economy. That's the key to really picking a cycle.
And in terms of that thesis, Mariette, what are some of the companies that have demonstrated the ability to mitigate this risk that's been seen in the B-grade office?
Most of them have. A few haven't, a handful haven't, and that's the bottom fishing area. Those that have, where it has cost them is in what I call defensive spending. making sure that if their offices are vacant, they are the best vacant offices. It's simple things like landscaping and cleaning and a good clean empty shell to show a prospective tenant.
You've spoken about offices now. What about retail? Are you preferring the office space?
Retail has always been the best performer, but the performance is very divergent, especially when the economy is where it is now. It's a bit patchy. What always does well is the big dominant retail centres, your Hyde Parks and your Canal Walks and your Cavendish Squares, all of those, because they are entrenched within their market, and also markets where there are more people, there are more demographics. You've seen all the townhouses developing everywhere. Now, if your shopping centre is suffering from a less spend per head because the economy is weak, but there are more people coming through, that still drives positive earnings growth for the centre. That is a very defensive asset. Where it is weak is when you've got the smaller centres with, for instance, a small spa with a couple of line shops and lots of competition. Those really suffer in times like this. So very divergent performance. It's about picking asset quality as opposed to asset type.
Mariette, just in terms of the actual supply and demand situation from where you sit, in terms of office space, retail space, and industrial space, I mean, many South Africans took part of in the property boom up to 2007 and bought extra homes. That all came to a grinding halt. What are developers up to at this point?
Developers are fairly quiet at the moment. There are some opportunities, and those are good. The very, very good developers who've been around for literally decades are still finding excellent opportunities.
And at this point, I mean, if you were asked to in terms of your portfolio, which listed property shares are offering the most value at this point? What have you been buying?
I don't like to say what I have been buying.
Oh, come on, I'm taking notes here.
No, my philosophy is a mix. I mean, the listed property sector, even though it has matured and grown, there still is, on a relative basis, a lot of illiquidity. So I have a core portfolio of those that are defensive, the ones with the very good shopping centres and the top quality offices with blue chip tenants on long leases and the very seasoned management teams. And then you trade around on a relative pricing with those who are not that strong in the current economy. So it's been quite interesting. Also in the environment where the biggest one, Growthpoint, for instance, and the second biggest, Redefine, are highly liquid. They're well known offshore. And with a global quest for yield, when they are looking for yield, let's buy Growthpoint. We know Growthpoint. So we find that Growthpoint is very volatile around all of this. So it's interesting. You've got your core in terms of property, good quality. You've got your trading in terms of the type of portfolio, and you've got to second guess what the yield chasers are going to do.